Coming up today, stocks closed at another record. What to expect in the event of a red sweep? What all this means for the global economy? China about to do big stimulus? Is the stock market entering crazy town? And JPOW refuses to resign. It's another great day, guys. Let's go. And welcome back, everybody, to the Daily Market Review. As this bull market continues to light up and S&P 500 powers towards 6,000 here. We are pretty much green across the board, everywhere except the defensive sectors. And even though my S&P 500 oscillator indicator is currently in overbought territory, like a lot of oscillators, it can stay there for some time. Unlike back in July, where it showed us a short-term top, it can also signal a powerful breakout like we saw back in November last year. When the market rips up on a big momentum thrust and it stays overbought for a few weeks, that is a very bullish signal. And since we're coming up to a very seasonally bullish period going into Christmas, I'm thinking that's what could be happening here as well. And it was really mega cap tech, those biggest companies, driving the gains today as they break out to a new all-time high. A little bit of a pullback in the Trump trade. Small caps coming back today. Another crush in the VIX index. Volatility being sucked out of this market. And just like I was thinking, before the election, volatility risk premium has been sucked out as well. Option dealers only asking for 1.79 points above realized, meaning they're expecting lower volatility around the corner now. We also saw a bit of a reversal in the dollar today, along with bond yields. And with that, a bit of a bump back up for gold and silver. Crude oil still just sitting above $72 a barrel here. And I'm glad I offloaded the rest of my DJT shares yesterday at $36 a share. I was lucky enough to scale out pre-market. My highest order filled at $53.50. I really thought I had a good shot at running up into the 60s. However, it looks like the short sellers have come in a heavy way. Yesterday, right off the open, and today as well. Because with a market cap of $6 billion, it's just vulnerable to short sellers. Given the company doesn't really make any profit and revenue is still really low, it's vulnerable to be pushed around. And so it did turn out to be a bit of a sell the news event on DJT. And I was lucky enough to get away with a bit of a profit on an overnight swing trade on it. Other areas of the Trump trade coming off today as well. Regional banks still up massively since before the election though, after yesterday's monster move. But still holding up really well, the prison stocks, Core Civic, slapping on another 25% today on massive volume. As did Geo Group, even though they missed on earnings estimates by quite a bit actually. Stock market initially gapped down, but bought the dip straight off the bat, added on another 13% today. And we've still got other stocks out there set to benefit from a potential manufacturing boom in America, Freight Car America. Ticker symbol RAIL. They built freight cars, still a tiny stock, 274 million market cap. It's been an absolute rocket show over the last couple of months. It too slapping on 11% today. But unlike some other sectors that pulled back a bit today, still holding up their Bitcoin, sitting at all-time highs, just below $76,000 a coin. And the bears are not going to be happy because in my opinion, we're in a raging bull market and you can just see that by the huge response and volume to some growth stocks and small cap stocks that the market is immensely rewarding for even slightly beating expectations and giving improved guidance. AppLovin up 46% today. Dutch Bros up 28%. We got Doximity up a massive 37% after hours as I speak. PetMed Express up 35% today. These are monster moves even for coming in with good earnings. Toast up 19% after hours on their earnings. And rival to Uber, Lyft up 22% today. And real estate tech company Zillow up big today, 23%. We've definitely got a raging bull in the quantum computing space. QUBT up 25%. And the biggest of them all, IronQ. Monster move today, even though they missed on earnings. Up 34%, huge volume. D-Wave Quantum doesn't even report earnings until next week, but it slapped on 29% today. And Rigetti Computing, also another quantum computing stock, up 19% today. We've still got the nuclear trade holding up as well. Oklo, backed by Sam Altman, 22%. Lightbridge having a good day, as did Nano Nuclear Energy. And even the company the government came after to start this week, that's partnering up with Amazon for nuclear energy. Investors bought the dip, now it just broke out to a brand new all-time high. Also doing well again today, Tesla, getting within an inch of $300 a share, sitting at this resistance zone that's been there for quite a while actually, going back to July last year. Chart's looking really good, a lot of volume coming into it, and why not? Elon Musk is going to be part of the US government now. This is a strong tailwind for Tesla. Not to mention the excitement about all their new products, Cybertruck, Tesla Semi growing, battery storage, we've got FSD, Robotaxi, Optimus Bot around the corner. It's a really exciting time for Tesla shareholders. Also doing well today, Meta, up 3.4%, just below all-time highs. Apple bounced back after they had a little bit of a soft earnings last week. Market's still not sure about the iPhone 16. They're really going to be able to help propel them back to growth. But the biggest stock in the market, once again, having another good day, Nvidia. Almost at $150 a share. Brand new all-time highs. 3.65 trillion market cap. showing the AI bull is well and truly alive, and we can see that. And a smaller AI stock, Nvidia, is actually invested in themselves. SoundHound AI, really interesting stock. They offer voice AI technology that can be used by many companies and other businesses like restaurants. You can expect in the next few years, an AI voice will be taking your order and a robot will be making your burger. The future belongs to those who own the code. And stick with me today because I'll touch on China. Having a pretty good day here today, bouncing up to a new monthly high, up 5.5%, giving a little bit of action in the Chinese securities. Catching a little bit of a bid there today on some volume as well. But we'll come back to the charts. First, let me just run you through some interesting stats, news, and research to get you well informed of what's going on out there. S&P 500 just had its best day ever after the election. Yesterday up 2.5%. We've never seen a move like it in the last 100 years. Translation, the stock market is very excited by this new incoming administration. They like what they see around the corner. And generally speaking, the market is mostly right most of the time. And this is coming from a place when the economy and stock market's already got some momentum. Already feels like we're in the roaring 20s to me, and this could very well carry through into the 2030s as America's getting its most pro-business administration it's ever seen. And we've got who I consider the best tech analyst in the industry. Guy who's been focused on American tech since the 90s and has stuck with it the whole time. Dan Ives of Wedbush Securities said he believes Trump in the White House will massively accelerate Musk's autonomous and cybercab vision for Tesla and help to unlock the $1 trillion of AI valuation alone on the story. So now that we're back at almost $300 a share, we're currently sitting around $950 billion market cap on Tesla, almost back to the $1 trillion club. Dan Ives thinks there's $300 of value in the stock just on AI alone, yet alone all the other products that they dominate in. And he continues to believe this is the AI sleeper story that could turn out to be the biggest. Keep in mind, Elon Musk is building the most powerful AI supercluster farm in the world. He's been involved in AI much longer than all these other companies that have scrambled over the last year or two. In fact, he funded OpenAI over 10 years ago with $100 million, with the objective of it being just as the name says, OpenAI. However, it's anything but that now. It's closed AI, pretty much owned by Microsoft for profit. So he's moving at light speed, getting Tesla and xAI to be some of the leading AI players in the world. And so this is a big change in American politics that has big effects for not only America, but the whole world. We're looking at a potential red sweep here, where Republicans control the White House, Senate, and the House, which we may know in a few days, week or so, as Republicans have already won the White House and the Senate, just waiting on the House to come through. And this has been a historic win. It's broken a lot of actually 20, 30-year records for how many popular votes the Republicans have got since the 80s and flipped a lot of traditionally blue counties from within. It's been a real red wave. And so I think Trump's second term is going to be a lot different from his first. I think he's learnt a lot from it. I think he's got a much more competent and well-chosen team this time. I'm hoping the mainstream media don't start a new hoax or some other manufactured controversy to draw his attention and energy away from leading the country for better. And I think with Elon Musk in there is an absolute game changer. You could think of Elon as the world's best creator of efficiency, and he's going to head up the Department of Government Spending and Efficiency, in which he's already looking at some crazy spending program, for which billionaire hedge fund manager Bill Ackman is sharing his voice on as well. I think they're really going to clean up the books, and this will be to the benefit of everybody and the US economy. And this has ripple effects all around the world. I can tell you right now, countries all around the world are scrambling to prepare and adjust for the potential of global tariffs. Trump talking about a 20% tariff on every country, on all goods coming into US, 60% tariff on the Chinese. He's going to use those tariffs to help improve the finances of the United States, and he wants to enact the full leverage of America, and something he's been wanting to do for half of his life, as he has a long-held belief that America's been going in the wrong direction and has been getting ripped off, something he looks to swiftly change. And we're getting reports he's already spoken to over 70 world leaders as they call to congratulate him and try and start with a good relationship. Already heard from Putin. He's ready to restore relations with the States. He's willing to talk to Trump, come to the table, negotiate a deal on Ukraine. Also heard Chinese President Xi Jinping says he's ready to strengthen relations with the States. He wants to get along with Trump. Him and Trump actually have a lot in common. Contrary to popular belief, they don't want war. They just want to compete on business, and they both love their countries and want to see them flourish the best they can. So like I said, mainstream media will convince you of otherwise, if not even trying to push us in another direction. But a lot of people might be surprised how quickly global relations and world peace can actually be restored, as we've clearly been going in a wrong path for a few years now. But that doesn't mean it's going to be a walk in the park for either side either. Trump will look to pull China in line. How the Taiwan issue unfolds is yet to be seen. China still artificially manipulates its currency. It's not a free-floating currency like all of ours here in the West. Still plenty of issues on intellectual property theft, the export of fentanyl into Mexico, which makes its way into the States, not to mention the vulnerability of Taiwan and the importance of them supplying chips. So there could be a little bit of a showdown, some tariffs, things might get a little heated before it gets better. However, I'm optimistic they can find a deal that is mutually beneficial and may actually be able to pull China more towards the international community instead of shutting them out and cutting them off with Russia, Iran, North Korea, and creating a big divided world. Like I said, Xi Jinping has already extended the olive branch. He's called Trump to congratulate him, and he's really looking to try and work with them. However, he knows those tariffs are going to sting when they're already down. China's economy has seen massive deleveraging after the property sector just got way too bloated, and so they could be about to roll out a big stimulus program, potentially over $1 trillion to help local governments shore up their property and a bunch of other key stimulus measures to try and achieve their 5% GDP target, as well as counteract any potential tariffs, as obviously America is still a huge export market for them. And just looking at Chinese securities, they do appear to be anticipating something good just around the corner. There's a China 50 index, Chinese internet stocks, ETF KWEB, popping up there today as well. Alibaba's still got a bit more work to do. We get to hear earnings from them in a week and a half. We'll also get to hear earnings from Tiger Brokers next week as well. So I guess it's likely we're about to see some stimulus. The question is, just how big are they going to go? If it's less than $1 trillion US, the market might actually be disappointed. But if it's really big, more than $1.5 trillion US, 1.6, 1.7, we may be in store for some more fat green candles just around the corner. Either way, they've been holding up pretty good with the Trump win here. Looks like that stimulus may override the negative effects of the tariffs. Let's just see whether that can hold up. But like I said, I'm optimistic. China can have its place on the world stage and they can be included instead of excluded. And who knows, maybe potentially Russia as well. But all sides will have to meet in the middle and that may take a bit of time. But according to Evercore ISI, they think the bull market is still an infant. They see the S&P 500 at 6,600 by mid next year. And they say the current bull's only 25 months old and that average bull markets have lasted more than 50 months on average, saying we may not even be potentially halfway through. And I get that feeling as well, since we're only 2 years into it. There's so much momentum. GDP, corporate earnings, now the most pro-business government, AI boom, global liquidity all-time high, central banks cutting rates. It's a lot to go against if you're a bear. And of course, we'll have our 10-20% pullbacks and corrections, in which the bears will claim victory. In my mind, they're just great buying the dip opportunities. However, according to Stifel, they think the stock market's entering crazy town as valuations reach a generational high. They think the S&P could reach the low 6,000s before plummeting back down. In other words, they think the stock market's about to top out once it goes up about 2 or 3 more percent. So the market's a mania with valuations near 80-year highs. Once again, pointing to the Shiller PE, or also very similar CAPE ratio. And for those of you who don't know, the Shiller PE ratio basically looks at the stock market's last 10-year earnings, adjusts for inflation, and gives us a multiple. And so like that article just pointed out, that research analyst, and most of what you'll see online, they point to this being near 80-year highs, and because the average is only 16 or 17, their argument is we're so far above it, we're double the long-term average, therefore it must come back down. However, as my regular viewers know, I make a different argument, and instead I put a linear regression line on valuation, which is the proper way to model data. Simple average is just that, a simple average, more of a layman's measure. However, there's good reasons why there's a secular uptrend in valuations over time, just like there's a secular downtrend in interest rates over time. For one, the stock market was a lot risky 100 years ago. Couldn't just fire up an app on your mobile phone and start buying stocks. You had to go visit the exchange. And a lot of bucket shops propped up all around the country. If you read Jesse Livermore's Reminiscences of a Stock Operator, he talks a lot about it. Basically, I just pull quotes over a tape ticker into offices all around the country. There'd be a chalk boy, chalk up the prices on the board, then the punters would roll in and gamble on stocks against the house. And just like Jesse Livermore will tell you, you win too much, they'll kick you out. Same deal with a casino or any other sports bookie as well. Modern day bucket shops are CFD brokers, contracts for difference, or Forex. When you're not trading on a real exchange, instead you're trading against a broker, and it's been proven over 80-90% of traders will lose money, as those brokers quite often engage in a lot of dodgy business. So just be careful of anyone who's promoting bucket shops to you. Make sure you're trading on a real exchange like a big boy. But anyway, the stock market was a lot more risky back here. There was wars, just life in general was a lot harder. Life expectancy was under 50 years of age. It wasn't even the Federal Reserve. There was no such thing as the Fed put till the late 80s. Mutual funds really took off in the mid 1900s. Index funds really took off in the 80s, 90s. All our pension funds buying stock every day. New technology, the ability for America to easily sell and distribute around the world. And for people all around the world to easily invest in America, definitely deserves a premium. They dominate in technology and a whole list of reasons. Now, I'm not saying the stock market's definitely cheap. I'm not saying it can't come back down to 25.20. It probably will at some point. I'm just countering the argument that the long-term average is at 16.17. Therefore, it has to come back down to that because for some reason, the stock market should have the same valuation as we had back in the 1800s, when in fact, this data suggests a strong uptrend. And even though we've got prices moving up, and for sure, if you look at a long-term chart of the S&P 500, it is definitely technically stretched. But something we don't have that is stretched is margin debt. And looking back in history, not just on this chart here over the last 30 years, but looking back over hundreds of years and lots of markets around the world, you'll typically find market bubbles peak when there's also a peak in margin debt. Like we saw back in the late 90s here in the purple line. Back in 2007, huge amount of margin debt in the stock market and property as well. Households were levered to the gills, massive deleveraging. And again, coming into 2021, which even though we're higher in the market now than back then, in my opinion, things were a lot more frothy back then. And we can see that in margin debt. Right now, we're still off peaks. And in fact, we're still below the linear regression uptrend here. So in other words, I think the market could still have a lot further to run. And who knows, on the S&P 500, we may not top out to 7,000, 8,000. Who knows? I wouldn't rule out 10,000. Secular bull market, 15 years old. Some secular bulls have gone for 22, 23 years. It's nothing to say this one can't go for 25 or longer. But even at 22, we could still have 7 more years left. And I know the perma bears out there just cannot comprehend that. However, so be it. That's a good thing about the market. Anybody can short the S&P 500 if they think it's overvalued and they think they can time the top. Then you can actually put your money where your mouth is and short the market. Otherwise, as we make our way through Q3 earnings season, still looking pretty good. Here's the results for today. Airbnb missing by a penny and a few others with slight misses. Otherwise, green across the board there. And what's interesting is the market's held up really strong, even in the face of a really strong dollar and bond yields, which is typically a bit of a headwind for stocks, and the cost of capital goes up. And interesting to hear from JPOW today, who just cut another 25 basis points, doing us bulls another solid. There's been speculation Trump may ask him to leave, as the two don't exactly see eye to eye. And I'm pretty sure JPOW is another never Trumper. But he said today he won't resign. He doesn't have to resign. He's not going anywhere. He's going to serve out his full term. I think takes him through to mid-26, in which Trump's expressed a desire to have some input on interest rates, not make the decision, but he wants to be part of the process of that, which again is another controversial thing. But the Fed itself is controversial and how they decide interest rates. I'm more of a purist and think the free market should decide what rate should be. Shouldn't just be a team of people headed up by one biased person. Humans are biased. You're better off letting an AI robot or the market doing it. So we could be in for a bit of a standoff between these two over the coming month. As obviously Trump will want rates to stay low. However, Powell, who's been ultra dovish coming into this election, may have already started changing his tune, unbelievably. I thought he wouldn't be so obvious about it and he'd wait till next month or January. But he did say today, we expect there to be bumps on inflation. And in fact, just looking at their latest statement today and what changed since September, they actually removed the text. The committee has gained greater confidence that inflation is moving sustainably towards 2%. Instead, they just left it as the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. So in other words, they got less optimistic on inflation today. What a coincidence, right? I wonder if we got a different election result, we would have got this statement. And it's not just this statement, in my opinion. The market's changed its pricing as well. December rate cut odds just slipped. It was previously a near certainty they were going to cut again in December. Now the market's not so sure. Almost given 1/3 chance they may stay on hold. And wouldn't that be funny going from a 50 basis point cut in September to only be on hold a couple of months later in December? But it could be warranted if the economy does continue to hold up. We just saw the fastest growth in more than 2 years on the ISM Services Index, climbing to 56 and clear expansion territory. Service companies such as retailers, banks, and hospitals employ most Americans and dominate the economy. Business is booming, nothing is slowing down, an executive at a utility told the ISM. However, there's still softness in the labor market and still yet to be seen what massive deportations of illegals could do to the labor market and inflation in the immediate term. Did see a little tick up in jobless claims, still only at 221,000. If we see the 3-month average for that climb above 250,000, that's going to be a bit of a red warning. But what exactly is the Fed's position here? Are they forecasting a weakening economy? Are they forecasting higher inflation? It's not really clear why they're lowering rates and still worried about inflation. And so in other words, this easing cycle is not certain, but the stock market doesn't seem to mind for the here and now because the 10-year yield is just just motored up, almost hitting 450 yesterday, pulling back a bit here today. Like I said, the S&P 500 appears to be on really stable footing, especially now we're coming into a really bullish seasonal period, and we're getting confirmation across all indices and sectors as well. In fact, the classic Dow theory, transports yesterday broke out to a new 52-week high, and so did industrials. As Dow Jones, famous journalist for the Wall Street Journal, back in the late 1800s, created that Dow theory along with the Dow Jones Industrial Index. And so when you got industrials and transports both breaking out to 52-week high, that's said to be confirmation of a healthy bull market. And we're also getting some other positive signs of growth expectations in the market. Looking at the spread of consumer discretionary shares versus staples. Really strong breakout yesterday, following through a bit there today. And a combined spread I use of 3 growth sectors versus 3 defensive sectors. It too breaking out to a fresh 52-week high on bullish momentum. And it's not just the States either. We've got a global equity bull market. Canada's TSX, strong uptrend. Germany's DAX just sitting below all-time highs. Japan's still consolidating, but could be shaping up here for a breakout. Really nice move there yesterday for Singapore, and the Aussie 200 just sitting below all-time highs as well. And potentially a contrarian play. Just looking at the price action yesterday in Mexico, really gapped down hard off the open on the threat of Trump tariffs. However, big money appeared to buy the dip. We actually gapped up today and held. And so Mexican shares could actually be a leveraged play on the US economy, especially if there's big tariffs from China. Some Chinese companies may actually look to set up shop in Mexico along with other countries in the world as well. Since they share a border with the States, that really close proximity, if the US economy continues to power ahead, that could potentially help Mexican shares, which have actually been beaten down a lot this year. And so as always, the technicals lead, the fundamentals follow. Also good to see a big dive in bond market volatility. Volatility being sucked out of financial markets, really chilling down. So they've done most of their repricing. We've just got a bit of momentum carrying us now. Q3 earnings has been good. We just got another Fed rate cut. JPOW hinted at staying on hold inflation, and stocks still didn't seem to mind, especially tech shares. Another good day here. Q's up 1.5%. After yesterday's smoke show in the small caps, up 5.7%. Monster move. And there's a look at my sector breadth table indicator. Really sharp bounce back in energy shares. With consumer staples clearly the weakest sector, only 34% of staple stocks above their 200-day moving average. The strongest overall, tech, industrials, and financials, with energy making a quick comeback, which we can see on the chart here, actually sitting right in a key resistance zone as I speak. Pretty good signs of accumulation there. And same with oil and gas. After it being beaten down for a few months here, we're getting some good green candles here. Could see a bit of a bounce back in oil and gas stocks heading into year end. Otherwise, I like the look of the long-term chart on the Russell 2000 small cap index. Pretty much sitting at all-time highs here after building a massive multi-year base. There's an old saying in technical analysis, the bigger the base, the bigger the space. And so we could be on the cusp of a big breakout in small caps. And that's why I'm really excited about what the future holds. And in fact, my new trading account for my stock pick service, which heavily focuses on small cap stocks, it's already up 21% in time weighted return since I started it in mid-June. Performing well ahead of the market, and I think we're just still getting started here. It's still early days, and small caps could really outperform in the coming years, especially since they're mostly American domestic companies, and we've got a strong tailwind coming from Washington in that now. That's all for today, folks. Thanks very much for sticking with Click Capital. Appreciate all your support, and I hope to see you back here again this time tomorrow. Cheers.